Welcome to our quarterly edition of the TA report. It's Monday, September 25th. You've got Bags, of course, and GP and Nick JFDI. But the quarterly report, we bring in our good friend and our fourth wheel, so to speak, our good friend, the pivotologist, the Cookie Monster. Cookie, thanks as always for hopping on and being with us.
Man, always a pleasure to join you guys once a quarter. It's amazing how quickly the time goes between these calls, you know.
It is, and we are flush with being able to pick when to bring you on. We're just completely picking the bottom or at a sell-off every time you come on, and it's uncanny, really.
Well, do you remember when you said, when do you want to come on the pod? And I said, let's wait until the end of the month. And I had a feeling this was going to happen. And that's why I suggest that's actually why I suggested that we don't do it until the end of the month, because I've been waiting for this. So
I have too. I've been holding my shekels and waiting for some buying opportunities, and I think we're getting them, right? Cookie, I don't know how you see the world. I thought GP put out a very interesting chart on the Qs this weekend. GP, if you want to maybe explain what that looked like. It was bad price action, but
yeah, so it was not the Qs, it was actually the NASDAQ composite, which is made up of over 2,500 stocks, which 55% is technology. So it's a comp, COMPQ, I think.
Nick, you got
Maybe
that?
not. No, just comp. Just try the comp.
Man, I'm in the driver's seat here. I'm not used to this.
Yeah, I know.
Type in composite, maybe. Type in composite, maybe.
Or just go to stock trades.
IXIC. Okay, that's definitely not it. It doesn't matter. Yeah, the reality is, right, so we have the NASDAQ composite, which is over 2,500 stocks, which is 55% technology. So it's definitely technology heavy, but also includes healthcare, energy, all kinds of consumer discretionary, all kinds of different stocks, and it's over 2,500. So it's actually bigger than the IWM, right, which I believe is only 2,000. And so basically, I've been talking about this since, I don't know, last year. Cookie, the Adam and Eve bottom. You have a sharp decline, then you have a rounding bottom, and then you break out, and then you're coming back and retesting the pivot. And that's kind of where we are right now, almost to the damn penny, right? It's kind of interesting to see the broader sector, the composite versus the Qs, which is obviously heavier weighted towards like Apple and Microsoft and stuff like that. The composite's a bit more balanced, is coming in and testing that key kind of pivot breakout level, and holding so far. So to me, this, as much as of it looks terrible, and last week was pretty bad. There was literally everything got stomped out. If you look at a lot of the options flow, you'll see that I think on almost every mega kind of name that's followed, every call strike was completely obliterated, every put strike. So that tells me that this was gamma driven, that it wasn't actually selling on a wholehearted level, that it was options driven, and that may flow into something more, but it pulled right into the pivot. And we're here today, Monday, where everyone was calling for a pretty decent follow through and crush, and we are holding. So it's starting to check out in the way, and the measure move out of this retest is right back to all-time highs, and then we have to see how the price action behaves. But the measured move is from the prior pivot down to the lows from this current pivot up, which gets you right into the all-time highs. So I like what's going on here so far. There was absolute price destruction in so many names, so it's hard to be like, oh, I can see the light, but I implore you to see the light a little bit more.
I mean, I'd even take it a step further that if we hold this range up here, I'd almost measure a leg from there up and then just extend that out. So, I mean, whether we do hold, I guess, obviously it sure looks like we are, but yeah, I'm in the same camp as you. Like if we hold this short-term or near-term measured move is right back at all-time highs. And even if we took out the low, the measured move is basically in line with like the 200-day, which is kind of right back to where, the breakout down here really started to pick up steam. So,
well, the three of us have been bulls for a while. Cookie, how do you see the world and to some this huge wall of worry that these perma bears keep posting all these head and shoulders and going to 1987 prices?
Well, I mean, I'd say I'm happy to see that. I'm happy to hear that you're all still bulled up because I was a bit. I mean, it was pretty frightening. You got to admit, the last couple of weeks, the price action has been pretty rough. But I think as far as we were looking at price and price action over the last couple of months is concerned, remember we talked about this a while back that we were due for a consolidation which could last a couple of months, similar to what happened after COVID, and in fact similar to what's happened after lots of previous breakdowns going back to 2018 and 19. You often get periods like this, 6 months, 5 or 6 months after the bottom. So I think the fact that it played out, I think is good. But then there's always that concern that is this the end of it, or does it continue further down? So as far as I'm concerned, as far as how we're looking at it, is cautiously optimistic that we could see further weakness. But for now, as GP said, and I think as Nick said as well, it's coming into all the right places. As far as patterns are concerned, I'll share with you some charts later as well.
You want to share your screen?
I can do that. I mean, I could literally spend the whole hour.
That would be fabulous.
But if you don't, but I'm always worried about taking over your pod. But I've got so much to share.
No, Cookie, go for it. You're not taking over our pod. We everybody hears from us every week. We get to hear from you once a quarter. So by all means.
And I want to share. Really, I want to address some of the like the talking points, like 1987 and patterns and repeating all this stuff, and what's currently going on with the big tech names as well. Because I think the charts can show everything. Really, we just got to be clever and wise enough to be able to set them up correctly, right? Let me just share my screen first. Just share my desktop. Here we go. All right. So where do we start? Okay, I'll tell you a story first, right? So let's start from the beginning.
Story time.
If you like stories, then I'm going to start with this chart. Now, I know you guys talk a lot about QQQ and tech. Actually, we could talk about QQQ and tech as well, but let me just start with this one first. So this is the chart going all the way back to 1994. This is for SPY, and it's a monthly time frame. So it goes back as 20, 25 years or so. And this is a chart I shared on StockTwits a year ago. And back then, the idea was, price was somewhere around here. So this is the end of last year. And, my thinking was, as a good trader, we've got to look both ways. So even though I'm always predominantly more bullish than bearish because the price action supports that, I mean, the market goes higher always, right? But at the same time, always open to periods of weakness, breakdowns, corrections, bear markets, and so on. So I put this chart together about a year ago to show the bears that I could actually come up with a bearier scenario than they could, right? So this was what I shared back then, which has this 15-year bear market going all the way to 2033, down to
A
180.
barrier. I like that.
Exactly, like barriest of them all, right? And all of this was based upon previous price action. So it wasn't pulled out of my ass, but based on how this. So this actually is a fractal of the 2022 bear market, but shown on the monthly time frame. So the 2022 bear market actually does this, right? And I've shared that chart on a daily or a weekly time frame in the past on the SPY, where you see these bottoms. So there's a bottom in June, we bounced to August, and then we came down to October, and then we did all of this on the daily time frame. So if you take that exact parabola and put it on the monthly, then this is what you get, right? So that's where that came from. And this was me trying to come up with something which was as bearish as possible. So that's what I shared back then. And also at the time when we were looking at what might happen in 2023, 2024, the thinking was, well, there are periods where, so if we just focus at, let's say, this channel top, so this area that I'm looking at, which is 465, which we did hit in July at 460, right? And 457, 460, this was actually my target for the year. This is what I projected in December, that we could see as high as 450, 455, 460. And I remember, I think, discussions that maybe we'd had as well in the past, where 2023 could turn out to be an inside year. So 2022 was a terrible, very, if you imagine a big red candle, opens at the highs, closes at the lows. So it's just a full-bodied red candle. And then 2023 is an inside candle. So 2023, if so long as we stayed below all-time highs, could be a consolidation year. So even though we got there quite quickly to 457, the fact that we started pulling back from there left the door open that even though we consolidate here over the summer, it could still mark the top of the year or the highest point in the year. And then we just pull back 419, 403, close around this area over here. So that was certainly in the back of my mind, that while prices are pulling back from this 460 area, we can't rule out that that is the top of the year, right? I mean, certainly whilst we're below this resistance, that's very possible. And at the same time, as far as how price might move during 2023, the scenario that we started with for the year was it could move like this period here, which is at the same trend line. You see this one here? That's where we are. That's exactly where we are. This 460 is on the same channel top. And back then, this is following the 2000 bear market, collapse, crash, everything, right? And then as we get, and then the price. So this is almost like a mini-me version of what happened in the year 2000. And it's interesting that it looks like that, because many times people have said, the tech bubble and the valuations in tech, and look at what NVIDIA is doing, look at all the Apple, and Apple's not selling anything, or they're not making money. How can they be valued so high? So the rhetoric was actually similar to what you might expect that might have been around when we were wearing nappies, right? This area over here. But anyway, price, so you get the bear market over there, price rebounds, and it gets to the same trend line, or it gets to the same channel where we currently are now. And so my going in idea for 2023 was we could see a very horrible bull market, still bull market, but very nasty, where you see price scraping along this channel top and pulling back regularly every 4 months to the 20 monthly moving average, right? Now, so 3 months ago, the idea was, okay, the shallow consolidation would be like COVID, after COVID, like this. There's 2 months over here, which is what we've talked about in the past. These 2 months over here following COVID, again, below the same resistance. Didn't reach there, but still below the same resistance. It consolidates here, the 9 monthly moving average catches up, and it pushes prices higher, right? So that was my base case, which is what I've said, this is still part of this shitty price action that we see for years over here. But that would be the beginning of it. So it looks something like what happened after COVID. The 9MA catches up, and then we race higher. So this is where we are right now. And what left this door open to the market behaving like this was taking out previous month's lows. So when in August we took out the July lows, then it made it more possible that we see the 9 monthly moving average at some point, because that's what price tends to do. You take out a previous candle low, then you'll tend to gravitate towards the 9MA on whatever time frame you're looking at. And so when in August we put in a candle like this, my first thought was September's going to be bearish. And the reason being, we retraced the breakdown, but we closed below the same resistance. So whether you call it hanging man or whatever, but for me, technically, the problem was We retrace the breakdown, everybody piles back in again, thinks everything's fine, but we still haven't taken out either the resistance over here or this trend line, this red one over here. And the red one is actually, where's that? That's also come from actually 2022. Right? So actually all of this pattern is based upon 2022. So it's interesting how on the monthly time frame, the fractal is identical to the 2022 bear market. But anyway, as far as this chart is concerned, so we're finding resistance there, we retrace the breakdown, and then September basically fills in the wick, right? So September fills in the wick, which is what you'd expect with a technical look like this. And then we're waiting now for, do we get to the 9 monthly moving average, or is this it? And so far, looking on the monthly candle, you can't really say it's a really meaningful bounce yet. I mean, we're still below the lows that we had in August, right? We're just barely below 433. So we're still below 433 by $1. And I think if we get above 433, then it makes it less likely that we see the 9MA. But while we're below 433, it's still possible that we get there. It's not far from here. It's 425. And the low today was 428. Okay. So using this chart, I'm still using this chart as a base for what might come next. And as far as bull market is concerned, I've said in the past, we've got to hold the monthly moving averages for the bull market to remain bullish in nature. Otherwise, it starts getting a little weak. And if you look back at all these previous bullish trends, bull markets, we always hold the 20MA. Once you start consolidating below that, then things start falling apart, or you get much longer periods of sideways and weak price action. So for now, heading into the remainder of the year, from this chart anyway, and I can talk about, use a daily to show something else in a second, but as far as the monthly chart is concerned, we've got to hold the 20 monthly moving average, which is at 413. Now that would be my, let's say, lower bound to how comfortable I would be with the market dipping. So anything less than 413 would get me a little bit more nervous, but holding above the 9 monthly moving average, which would be fine. Now, all that seems quite straightforward, but there's one other thing on this chart which is important, and that's this parabola, which connects all the lows from 1994. Now, I mentioned this in the past anecdotally. It's almost like, you know, you have the internet, the birth of the internet, then you have mobile, you have cloud, then you have AI. And AI could be the end of this huge cycle, which lasts 24 years, 25 years. And you know what's interesting is typically what you find with parabolic supports like this is they get hit 4 times. So this is the first one in 2009. The second one was in 2020 with the COVID. And then we get the bear market, which is number 3. And then eventually, we can't ride it forever, right? Because it gets steeper. Right? I mean, we could ride it for a long time, but it gets steeper and steeper. It's still not vertical. But my target was for the market was that we'll eventually break down below this parabolic support at the end of 2025 when we revisit this point there at 642. So assuming the market, well, so there's 2 ways this could play out in a bullish fashion, right? So I'll start off with the bullish case first, and we'll talk about how things could break down. But from a bullish point of view, we could actually just grind like we did in 2004 to 2008, like this, until the moving averages catch up. And those are the ones that will push price through this resistance at 465. Whether that happens quickly or whether it takes a few months, that will be what will do it, right? So you'll need those moving averages, and the 9MA is still rising. So that is going to apply pressure, and it's going to create this convergence over here. And you can see it's almost like a little wedge, you see, with the parabolic support over here. You've got the 9MA riding up. You've got the 20MA, which hopefully should turn, because it takes time, right? So the 20MA is going to be the longest one to take to actually turn. It hasn't turned up yet. It's still falling, so there's still that risk. And you know, that's another reason why we've got to be cautious with what might come next, because the 20MA it still hasn't healed yet. So we've got this period here, which could end with this wedge formed by the parabola and the downtrend line, which is March of next year, which could be around the time when there's more clarity with what the Fed is doing. And I think, you know, it is possible to sort of see into time frames and marry it up with macro and stuff and say, well, it would make sense that the market goes nowhere for 2 or 3 months until we see more clarity and resolution for what the Fed's going to do as far as loosening or tightening or further tightening or whatever, right? And in the meantime, we're seeing pressure from this parabola from below. So the mega bullish outcome would be that price is pushed up, the 9-monthly moving average guides price into this resistance, and it pushes up, and we end up at 642 at the end of 2025. The less bullish but still bullish take is that we bounce between 465 and, let's say, the parabola. So this area over here, 420, 465, and that goes up, and this goes up, and we just end up staying in this sort of area for about a year. We never really get above 500 for another year, right? So I mean, we might take our all-time highs, but we might just still stay very close to them. So this is 480, this is 495 in the middle of next year. And if you look at the chart as it is, I mean, it's not unreasonable if you think about how the monthly candles have moved all along, all over the last decade, including this period that we looked at earlier. It wouldn't be unreasonable for them to continue to do that for another year. And knowing how the market has behaved over the last year, it would not surprise me at all that it continues to annoy everybody for another year. And I think one of the reasons why many of us have struggled is just expecting prices to be more robust for continuous and long periods of time. Let me show you a different chart. Let me do that. Let's go over here. Let me just pull this one up over here first. So this is actually it's a futures chart. So this is ES, and I put this together recently, just a couple, maybe a month ago, to illustrate what the market has done since the bottom in October, to give a better appreciation of what's actually happening now. Because I think the reason why everybody is so frustrated in the market is because they didn't stop, or they haven't stopped to understand the type of price action that we've seen, not just recently, but for the last 2 years. This is the bull market from October. And what these two ellipses show are two identical cycles from October to, let's say, the middle of June. And now you've got this one, which ends at the end of December, or the last week of December. And what we're seeing is, even though the route or the path that price has taken through this ellipse is different to this one, the volatility is identical. You get the same movement. You get prices going from the top to the bottom. I mean, clearly we've got the channels behind as well to give a simpler view, but what the ellipses are showing is prices are riding up the top, going to the bottom, go to the top, go to the bottom, and then just move to the end. And then at the end of the ellipse, we get that move higher. And then you get that riding to the top of the ellipse again. We come to the bottom, we go to the center line. And these white lines here are the two axes of the ellipse. So you've got the vertical axis there, and you've got the more horizontal axis there. And then at each of these center points, prices are cratering. At each of these center points, in the middle of the cycle, you're seeing prices weakening to go to the bottom, just like they did over here. And so what I was able to show using this chart was, not only is this not surprising, but it's very similar to what it's done in the past. I mean, almost identical. And these are the areas that I was looking at to buy this week. So 4327, 4316, and we came very, very close. In fact, the low, which was 4338, was a pivot on my 4-hour chart. So this is on the daily, but 4338 is in fact exactly a pivot on my 4-hour chart. But the reason why I wanted to share this with you guys and the guys who are listening as well is, I think in order to be able to survive in this market, we just need to have a much better appreciation of the type of price action we're going to see, at least for the next year, maybe 2 years. And I think unless we start off with a mindset which is a little bit more in tune with what the market has done, we're just going to burn out. And even though, and the irony is, even though I share this with the guys who are subbed on my Slack site, we still struggle. It's very, very hard, because even though you have an idea of what might come next, it's still very difficult to execute. It's very difficult to execute, right? Even though you have this, and it looks like, it makes sense. It does make sense. And also just for the bears, right? For everybody, right? It's not just for the bulls here. So the bull market did this, and the bear market did the same thing.
I was going to say the same thing, or I was going to suggest that, as in, we spent, all of 2022 pretty much in a pretty solid downtrend, and then we chopped sideways for almost a year and a half. Like to expect that we're going to just absolutely rip through all-time highs and not have, we talk about it all the time. Like a lot of times what people are arguing about on the internet is time frame, right? Like, anyways, I didn't mean to cut you off. I just we should be expecting some consolidation up here at highs. I mean, it'd almost be kind of foolish not to, just based on the rally that we've had all year.
Right. But
And I think this also lends to the overall kind of monetary shift, right? Like you have this, your money can actually work for you now, right? You're getting 5.5%. So people are going to be squeamish about putting more, like the V-shaped recoveries. Part of why that happened was there was no other alpha in the markets besides the markets. You couldn't get it anywhere else. So people were piling into equities, and now you have this. It's almost an opportunity cost. Well, if I buy this equity, it might go down 20% in a week, aka Netflix, right? And or I can put it in treasuries, and I can get my secure 5.5, 5.2, whatever percent interest rates, and I don't have to deal with this market. So you have this opportunity cost from market participants saying, I can get better returns without any risk while the market figures itself out, right? And so if the market figures itself out higher, then that's also kind of what you're talking about, Cookie, where it can go parabolic, right? All those people who missed out on the 30-40% gain are now taking their short-term treasuries and piling it into the markets because the economy is resilient or whatever it is, right? So you also have that monetary shift that's happening in the background on why there's hesitation and quick moves down in the markets, because people are like, screw this, I don't want to lose 20% in like a week and a half when I can just peacefully not worry about my money.
Right, and I agree with that. The only thing I'd say is, as a counter, is I think people are. We're not giving financial advice, obviously, right? But I think it's a mistake, and the reason being, in order to achieve 5% in the market, you just need to be in the market for long enough, and it's less than a year. So, the trade-off is the volatility. So you got to accept the volatility. You just got to do nothing, right? You just got to accept the volatility. You got to accept that it's going to be like this, and this is part of the reason why I go through this.
Talk about humanness.
But let me just comment. The thing is, it's hard to accept the volatility if you're not prepared for it.
Yeah.
Right. So if you're prepared for it, if you've seen what's possible, and that's your mind, and that's how you train your mind. Because I mean, obviously, like with everything, right? You gotta train your mind. You got to train that muscle to be able to understand what might come, and then you'll be more prepared to accept it. If it comes as a surprise, which I think is the problem in most cases, right? The price action is surprising everybody, but it shouldn't. If you go through an exercise like this, it won't surprise you. And this is the point I want to make. So all of 2022 and 2023 looks the same. I mean, the bears, even though they say, 22 bear market, we made a ton of money, but they lost a fuck ton of money as well.
Oh God, yeah.
Right. I mean, actually, the market went up for more days than it went down, even though net it went down, and the down days were bigger days than the up days. But in terms of periods, there were more up days, or there were as many up days as there were down days, and that was what really cost so many people mental health. And it's the same in 2023. So in 2023, the market is up by a healthy amount, but you go back and you take a look at how it got there, and everybody is having kittens, right? As we say in English, right? It's a nightmare. Just one other point as well on this chart. The market goes sideways for 5 months of those 6 months in that cycle, and then it goes up for about a month, and it's going to do the same again. So here the idea is that if you don't time it well and you're looking to time it, or you get frustrated and you don't buy the bottoms or you don't buy the dips and stuff, you end up getting frustrated with the sideways price action. You will miss the easy periods because you're trying to be, clever, whatever. Right? But there are periods where the market will be up quite strongly, I think. I mean, it could break down here, but it's nice to see that it held this support, which is what I was looking for this week, right? So with all the bearish rhetoric, and prices felt like a rock. So here we are now. So in terms of what could happen next and my projections for the rest of this year, if you want, I can just share those, right? So I'm looking for this cycle to end around the beginning of when would that be the Santa Claus rally? I'm guessing it would be, right? Around this time.
Santa Claus rally is the last 5 days of the year.
Well, there you go. Perfect, right? So what I've been looking for is for prices, I mean, a modest move higher of 300 points, 400 points from here till the end of the year, which might not be a straight line, but I've been looking for that. And whilst that might seem unreasonable on the surface, well, we've done that before from even below the ellipse. Right, so over here, back in March, we went from 3,800. We ended the cycle at 4,200. So a 400-point gain, and it will be very similar to here. And it will end up looking like a cycle that we had in the first 6 months. So it's very organized. I mean, this market isn't collapsing. It's not breaking down. It's not bleeding out. I think the reason why the market is doing this is partly in line with what, trying to mirror what the Fed is saying, which is really just higher for longer, wait and see, higher for longer, wait and see. So those are natural headwinds, but there's robustness in the economy and in the market. So the market wants to go higher, but every so often it gets knocked back for whatever rhetoric is out there at the time. But like a basketball you hold underwater, it comes back up. And I think that's what we're going to see again. I mean, clearly this could break down. So what I've just said about the market going higher, clearly that's not going to be as likely if we start breaking down through supports and stuff. So 4,300 for me, I think is an important level to hold. We could end up going down to those monthly moving averages like I mentioned on SPY, but it would be, holding this area here is basically holding the 9 monthly moving average on SPY. So that would be consistent with that. And then we move higher from here. And also if you notice, these ellipses are actually displaced a little bit. So this one has a center line, which is here. And this one has a center line, which is here. So and that's just the way it is. That's just the way it's played out. Now, if I was to do that, copy one of these and move it into 2024, put it up there. So each of these ellipses is moving up by half a channel. And that will be where I think we will end up in 2024, this space over here. Right. And we'll get something similar. And whether the market at that stage, let me just zoom out a little bit. If at that stage we start resembling a market like this, which is what everybody wants, except the bears. But if this is what all of us want, if you're swing trading, this is the type of market you want, where you get routine pullbacks to the 50 moving average, all the other moving averages get hit now and again, the 20, the whatever, all good stuff, right? That's a much nicer market to swing than the market that we had over the last 2 years for bulls and bears, right? So my guess is that as we get closer to this third ellipse, this third cycle over here, that we'll stop seeing this type of price action. And we might just see price contained within the top half of it, or maybe just, and I'm just thinking aloud here, imagine if it was something like this, that price stays within one of these channels up here, something like that. And it starts up something like that, right? So it doesn't come down into this area over here, but it's contained in that red and the green space up there. I mean, clearly I'm just guessing here, right? But at some point the market is going to be repaired, and I think this is a 2-year program. And we can talk about who's behind that, which aliens are controlling that, but whether it's the Fed or the aliens in Mexico or whoever the fuck's behind it, right? But this is a 2-year cycle, and it will eventually end, and will hopefully end up with a market that's a lot more interesting for investors and a lot more interesting for traders as well. So that's what I'm thinking.
I dig it. Kind of just manage your expectations, or don't have any.
Yeah, go ahead.
Like going through the if-thens, as a technical trader, that's generally what I'm trying to do. Is I look at the monthly and the weekly, have a kind of a broader, bigger thesis in terms of what direction I think we're moving longer term, and then just dropping down to kind of fine tune it. But Yeah, yeah, a lot of what you have to say, I definitely I resonate with a lot of it. So
Can I share something else? Can I share something on the VIX? Let me see what I've got
also, oh, you
Yeah.
switched. I was gonna ask, I think you switched screens, but bro, you had like 25 tabs open. How do you do that?
Oh, really? Hold on. Did I switch tabs?
Or
tell me
maybe you closed some out. Initially I was like, man. it
Oh,
looked like
yes, I did. Let me show you. Hold on. Let me just,
It was all good.
I'm just trying to find out where I am. Oh, damn, what's going on here? Okay, so here we go. I don't know what you can see now. Is it the SPY chart again?
Yeah. I was just
Okay.
looking up above on the Chrome tab. It looked like you had, it looks like you got,
I got
like
lots of
25 tabs.
Because I prepared. I prepared for you. Yeah.
Hey, we appreciate it.
I got all of these things ready for you guys, but there's a couple of things I want to just share with you as well. Just really interesting, right? Let me go back to here and see if I can. Let me see if I can find my VIX. Right, so I did say I'd talk a little bit about the VIX, and it's really interesting. It really is. Hopefully, you find it the same. So this is what I put together. I shared it on Stocktest just a couple of days ago. Let me just get this. Actually, let me load up the chart again in case I've got it wrong. There we go, right? So this is basically looking at the VIX ranges in bull and bear markets going back to 2019 or so, right? And what I was looking at was, or what I've often done is to say, well, to try and understand what price is doing now, I need to compare it to something else. And what most people try and do is they'll compare this period to other bear markets. For example, they'll compare it to the bear market that we had last year. So they'll pull up comps versus 2022 most of the time, or they'll pull up 1987, right? Or they'll pull up some other analog, right? Which drives us a bit nuts. But what I'll tend to do is to say, well, if this is a bull market, then the VIX will behave as if it was a bull market, right? And it's possible to say that because the VIX does move in ranges very regularly. So here what we've got is, if we go back to before COVID, right? So this is the range that the bull market, that the VIX moved in the bull market prior to the COVID breakout. This yellow box over here. So it moved down to 12, and it moved from 12 to about 18, up to about 20. So this is the range that it moved in. And if you notice, it does it frequently from up and down. You've got these different contract rolls, you've got the contract gaps there, but it tends to move. Maybe you can say, okay, maybe the high of the range is this area over here. It doesn't always get to the top of that yellow box, but certainly this was a bull market, and this was how the VIX looked during that bull market. And then there's other periods which were bullish as well, which is this greenish sort of area over here, which again, you see the VIX moving up and down. So this is during the year 2021, and this gave us regular dips to the 50-day moving average. Over here, all of these spikes here were to the 50-day moving average. So these were my reference points. So when I was looking at 2023, is this a bull market or not? Well, you can say, well, yes, it is, given how the VIX looks. And then the next question, well, okay, well, if that's how a VIX will move during a bull market, where are we likely to see dips in the market? And what I've done is I marked this level, which is 18, which is sort of cuts this yellow box over here. And it's actually some of the spikes down that we had previously as well. And I'd mark that as an area where the VIX might go to if we get spikes higher. And all of these dips that we've had more recently have seen the VIX go to these levels over here. Now, this is where it becomes actionable. If in 2022, and with hindsight, it was easy to say this, and certainly towards the end of the bear market, the discussion was sell positions when the VIX is at 20 and buy when the VIX is at 33. Right, there was that discussion as well last year where the VIX has got to go to 40. It's not, we're not ending the bear market until the VIX goes above 40. This is all crap. This is still just a bull market, a bear market rally because the VIX didn't get as high as 40, right? But I remember saying last year that the VIX doesn't have to get to 40. Every time the VIX got to 33, the market was putting in lower lows. So it was continuing the bear market, but the VIX didn't have to put in higher lows. It didn't have to get to 40. So with that insight, I thought, well, maybe in 2023, we could see the VIX continue, routinely hit 18 to 19 and give us the high of the range and the low of the range being around 12 or 13, which is where you'd want to exit some of those positions. So what we've been looking at as far as a trading strategy is concerned is, if in 2022 it was buy at VIX 33 and sell at VIX 20, well, in 2023 is sell at VIX 13 or 14 and buy at VIX 18. And this is where the VIX is actually topping today. So right now, if you look at where the VIX is, and and I know with a cat, everyone, a lot of people say you can't chart the VIX, but the VIX is sitting just underneath my pivot here. So 1762. So this downtrend line connects the previous highs that we had in August. So if we were to get to the top of the range, which is possible, we would need to break this downtrend line to do so. So the if statement here is, we could hit the top of the range in the VIX if we take out 1762. If we close above 1762, then it's still possible that the VIX gets to this area over here, which would be in line with where the VIX has previously gone during bull markets. So it wouldn't be surprising to see that. So as far as actionable insight, as far as trading this week is concerned, that still stands. Now you can see we're at 1753 now. Tomorrow that's going to be 1753. It wouldn't surprise me, 1750. Right? So we're already hovering around what would still mark a breakout in the VIX if it closes at or above 1750. And as far as looking at what the VIX has previously done, all of these breakdowns in the VIX below this support is identical all the time. This uptrend line is identical. You'll often see the VIX coming back and retesting it. It breaks down and then it retests it. It breaks down and then it retests it. So if we break above 1750, then I'll be looking for the VIX to get close to 20 by the end of the week. This area over here, it could get up there, and it would still be a buyable dip in the market. And this would be what would give probably around 419 to 413 in SPY. The 20 monthly moving average will probably coincide with a VIX resistance level. They nearly always do. So even though many people out there still think that the VIX is random and you can't chart it and stuff, I'd go beyond that and say the VIX levels actually line up with weekly and monthly moving averages in the indices. And even the daily MA. So the daily 50 MA in SPY will line up with the VIX pivot. And that's not random. It can't be random. So that's just another bit of information, which is, I think, hopefully you guys find a bit useful. And I think if we go above 20, then I think the market's going to look a little bit shaky. Right, then you start seeing, the possibilities that we could get to 25, which would be not out of the ordinary, because that's where, you'll often see, we've seen spikes to 25 in the past in the bull market in 2021, right? But you get a pretty nasty pullback if we get to VIX 25, I think, this year. If the VIX goes up there, then I think the market's going to be below 400, or it's going to be around about 400, maybe something like that, 405, something like that. But
would you then expect a range on the VIX then from like 25 to 20 or like 25 to 18 and kind of bounce within that range then until it kind of... No,
well, a priori, no. I mean, my thinking for this year was we may get occasional spikes to 25, but I'm not expecting the VIX to consolidate above 20.
Okay.
Right. So basically, I'm looking for the VIX to remain inside this yellow space, but we could be unfortunate. I mean, for example, there's some catalyst out there that we don't know. I mean, maybe like another bank goes under or something like that, which is possible, right? So if something happens, the next 2 months, because interest rates are high for longer and too high for too long, all that stuff, and something breaks in the economy, then we could see a VIX spike to 25. But I wouldn't expect it to stay there. Just like what happened over here, just like what happened on previous occasions when it got to this area over here. But sustained moves above 25 would be worrying. So I think for now, rare but possible moves from 20 to 25. We could get a move, quite likely to 20 if we hold above 1750 this week. So that wouldn't be unusual, and it wouldn't be something that would scare me or surprise me. Right, and this would just be in line with getting that better dip in SPY, getting that better dip in Qs, and the Qs could go down to that. I think Nick, you were looking at as well, 330s or something like that, and we could get that. I mean, for the VIX to go above 20 to 25, we could get a pullback to maybe the 330s in the Qs, but it's not my base case for now. It's not what I'm looking for. I mean, clearly I could be wrong, obviously, right? But it's not what I think is going to happen, unless something breaks out there, which I'm not foreseeing, right? But unless there's a catalyst, I'm not expecting the VIX to get above 20. And so as far as trading is concerned, so Tesla, Tesla, Nvidia, all of those names, reached the lows in pre-market and early this morning when the VIX hit 18. Right? And what we discussed on our Sunday call yesterday was buy the fear. And rather than it just being a throwaway statement, buy the fear, sell the greed, all that stuff, we want to quantify that fear. So we're buying quantifiable fear based on the VIX. So if the VIX gets to 20.79, that's the fear we want to buy. So we're scaling in here at 18. So we'll have a scale entry here. If we get above that, then each of us can choose whether we want to get rid of that entry we bought or hold on to it and add to it again if the VIX gets to 20.79. As to whether we get there or not, I've got another thing I can share with you as well, which is really surprising. You want to see that?
Yeah.
And the tech names. Yeah, tech names. I'll show you something that's really cool, right? So now we're going a little bit granular. So this is a chart that I shared on StockTwits. And it wasn't all of this chart. Actually, I worked on it a little bit after I shared it. But what this chart shows is basically it's the bull market in Apple since forever, right? Going back, going all the way back to 2017. It shows the bear market. It shows the consolidations. It shows the very clear resistance levels everywhere. So even the highs that we got over the summer coincided with the top of a channel. The spaces between the gray channels are identical and they're the same size as the gray channel. So I've just not put them there because I didn't want to fill the chart up with too much clutter. So there you go, like that. So it's the same thing, right? And it could go all the way back down to here, continue all the way down there. But anyway, so there's that, right? So right now, so Apple pulled back from here. And now what I've tried to do is in line with what I mentioned earlier, that the market could move. It could grind higher, annoy people, but not break down. Right? So again, my base case is the market is going to continue to go higher, but it's not going to be as clean and as easy as everybody wants. It's going to piss off the bears, it's going to piss off the bulls, just like it's done over the last 2 years, but it's going to go higher. And for it to do that, I want to try and model what the consolidations might look like in this uptrend, in this move higher. And what I found was, and this is the really interesting thing, right, is I've been talking about how this period could resemble the post-COVID consolidation. The post-COVID consolidation is over here, is this period over here. This is the summer of 2020, like this. But what I found was that this period over here is repeated many times on the chart. Even COVID itself is one of these fractals. So when people talk about 1987 and 2008 and all this other stuff, it's absolute crap because it's, while those analogs could play out, you can't discount them, right? They could play out. But what's actually playing out is the market is putting in very consistent and identical consolidations every now and then. So this period here, and it's the same as this period over here. It's the same as this period over here. And it's the same as COVID. I mean, so in other words, what you're finding is not only are the consolidations the same, but the bottoms were the same as well. It's the same structure, the bottom and the consolidation. So whilst this looks like what happened after COVID, it also looks like what happened in December. And not only that, but these consolidations are identical across every chart. Tesla looks the same. This is Tesla. These are the same boxes. See, they're the same consolidations over here, over here. It's exactly the same. So I've copied them from one chart to the next to show that the market is moving as one, and you're finding very consistent consolidations. I mean, what is uncanny, right? Look at that. It's the same move down. It's always the same move down, right? So this is giving me an idea to how, in terms of expectations to how the market might move in a period where the Fed is still grappling with what's the next best step. And the market is trying to come to terms with what's the next best step, but the market itself wants to go higher. It'll look like something like this. And this period here would last, for example, until the middle of next year. Now, clearly, so this is like 7 or 8 months. And I think it makes sense that the market does try and go, rather than breaking down, it consolidates in a wide and I would say appealing range for those who want to trade it, but a slightly annoying range for those who just want to swing it. Right. I don't think the market is going to break down, and it could. I mean, I could be wrong, but it was nice to see that even though I prepared these charts days ago, it was nice to see price finding support at 238 this morning. So I had a limit order at 236.5, and I thought I was being generous by giving it $1, and it didn't hit. It came down to 238. right? So it came down to this area, and you can see it's very similar to this space over here. Now, if you're wondering what these two different shaped wedges are, I went further and I tried to model the consolidation in two ranges. Said, okay, so this is the big range in yellow, but there are times when, and I looked at what happened after COVID to give me that additional idea, which was there are times when price doesn't come down to the bottom of this yellow wedge. It stops halfway. So maybe that repeats as well. And it does. It stops over here. Right? You see
that, or perhaps like an indication of real strength.
Absolutely, you're right. That's a good way of saying it. So how strong is the uptrend? So you get uptrends which then are, and actually what's funny is even though this is on the weekly time frame, the 4-hour chart for Tesla looks the same, meaning you've got this consolidation between the 4-hour moving averages, which is routinely hitting the lower 4-hour MA, as opposed to strong uptrends which rarely go below the 9 MA. So this period here, which was after COVID, rarely went below the 9 weekly moving average. It was a very strong uptrend. So over here, when we saw this period over here, my expectations were, I'm going to wait for price to get back to the weekly moving averages because that's what it's done in this weak bullish uptrend. I'm not expecting it to do anything like this. So each time when I saw people getting very excited about Tesla's going to break higher and Tesla's going to break higher, I was slightly more measured and a little bit more cautious for that reason, just because I've seen how it's consolidated in the past compared to really strong moves up in Tesla. Now, clearly, this doesn't discount that the market then morphs into an uptrend like this. But for the time being, I'm not expecting that. And at most, I'm expecting, or at best, I'm looking for price to hold this 230, get to 300, and stay in this range for the next 6 months. And I might get higher than that, and we'd be happily, I'd take it. Absolutely, I would take it. When my base, and this is the same with everything that I've seen over the last 3 months, my base expectations are a lot more measured, I think, than maybe some of the bulls out there right now. So I would love to see breakouts above 283, 295, and I'll take that. But if it doesn't, I'm not going to cry over it. I'm not going to get upset because that's what my baseline is, right? And I just got to come to terms with it. And the way to come to terms with it is, okay, so if the market isn't going to give me a very clean bullish uptrend, then I'm just going to trade the ranges. It's the next best thing. If I can accumulate Tesla shares for free by selling at 257 and buying at 235 and doing it for as long as this range is there, then I don't really mind, honestly. I mean, if I can accumulate 5% shares every month even, or even every week, then I'm going to do that. I'll try and do that. And then eventually it'll break out. I'll be carrying twice as many Tesla shares as I was before I started, right? And they're all the same. So Microsoft is the same. All of them. I mean, it's the same thing. They're all the same, right? It's amazing, right? So what's this one? This is Google. Again, the same thing. They're all the same, right? And
I think that's the Cookie. Just quickly, I think that's the thing that stood out to me the most over the weekend, which was the patterns are nearly identical, right? Like in all these names. So like you don't normally see identical patterns when things are breaking down. So these are all signs to me that it's healthy consolidation, right?
Yeah. And I would go further. I think for me, it puts my mind at ease that I've seen this before and I don't need to worry about it until it actually breaks the pattern. Right, so that would be the takeaway, right? So if you go back to Apple, which is maybe a little bit easier to see, or actually it doesn't make any difference, right? So I've put in, okay, so so this is Microsoft, right? And Microsoft did hit my pivot. So it hit the bottom of the wedge. So the low today was 315, the pivot is 314. So again, this is the same, taken off Apple and Tesla, all the same. And if it goes below that, then what does that mean? Does that mean it's over? And I think the risk does increase because once you start seeing changes in the consolidation, then you've got to be open to a slightly worse outcome. I can't just ignore it. There's no point in having it if I'm not going to follow it, right? So if we don't hold 314 in Microsoft, then I would buy the dip to 300 because as long as we stay above the major, let's say the barriers, right? So this is like a relay race, right? Where you're jumping over each of these barriers or the hurdles, right? It's the 110-meter hurdle. So as long as we keep going forwards and not going back below into the gray spaces, then it's okay, I think. Wait to be, it's still let's see, right? But because we're below the 9 MA, we're below the 20 MA, we could consolidate all the way down to the 50 weekly moving average. But for me, for now, as far as this week is concerned, it would be great if we can hold 314 in a name like Microsoft. If we don't hold 314, then I will buy the dip at 300, because that would just end up looking like a back test of this, and it will stay inside this breakout space. And then and then maybe you get, a consolidation that moves higher from there. And that's how I'm basically looking at all of them. It's very mechanical. I'm actually, now that I've done the work to create the template, I just got to apply it very mechanically, right? And not think too much about it. Otherwise, there's no point. It defeats the purpose, right? But I think for now, as I mentioned earlier, I think I like that the consolidations are identical. And I like that we've seen these before. So it stops me worrying. And the fact that I mentioned before about the bull market, and this is the starting point, the VIX is moving in a way which is consistent with bull markets. So then the consolidations are moving in ways which are consistent with bull market consolidations. It all ties together. Now, clearly, that could fall apart. These consolidations break down, the VIX breaks out, and then we're in a different paradigm, and then we'll evaluate that. But for now, I don't want to overthink it, because this is quite simple and quite straightforward. And it allows me to then do two things. One is be more patient, understand what could well happen in the next 6 months, and not cry about, we don't see 50% gains every 6 months or so. At the same time, realistic to that we could still see gains, but they'll be more modest and measured, and not worry about things breaking down unless we see VIX breaking out and those consolidations falling apart. And I think that peace of mind, I think, is what I think will help most of us, a lot of us. Yeah.
Always took away from you was be open to whatever situation, right? When we would be on your weekly calls, and you still do this when you share on Twitter, but like, you have your base case, but option B or option C are possible. And how do we stay prepared for that, right? The VIX spiking up and breaking out, that would be, like you said, a paradigm change. That would mean option A's, you might have to pivot to option B or option C. It's something that we say a lot here on our pod, right? Is you got to trade the market we have, not the market we want. And a lot of that, I think, Nick, you hit it out of the park early on. Is a lot of it is confusion about time frames. And when you see the bigger picture of larger time frames playing out, you are more set in your conviction of option A is a 70% likelihood, but these other scenarios could play out, right? It's sort of the larger frames leading the smaller time frames.
Well, that and just the importance of risk management. Like from what Cookie has shared, it's like we're seeing these patterns repeat over and over and over again. That means the behavioral, our behavior is more or less repeating. As soon as you see price, break one of those channels to the, again, breaks one of the channels, you're like, well, holy crap, character change, behavioral change. How do you, at that point, you either stop out and reevaluate or what? Yeah.
I think what's, just adding on to that, Nick, I think what's interesting is how the market will stretch your emotional resolve in both directions, right? And these moves are pretty severe. And this is Microsoft, which is actually one of the stronger names out there, right? But, so this went from 340 down to 315, which, it's quite hairy, but there are others which are worse. But that move, you'd expect it to be the beginning of the end of the world. And this is where I'm a little empathetic with the bears, where they'll see price action like this, and it's not small. I mean, it's pretty significant. And you'll think, well, yeah, maybe the world is falling apart. And I think for even the strongest of us, 10% move down that quickly, it makes you question your resolve, right? And I think the good thing about exercises like this is it helps you see that it happens over and over again. And I think that's the real key. And I think that's the strength in an analysis like this. It helps reinforce that we've just got to recalibrate what brown pants means now, right? So back in the past, brown pants was, a 1% move down or 2% move down, and you think it's going to turn nasty. But now the nature of the market is a lot more, I don't know, it's a lot more ruthless, isn't it? Both ways.
Yeah.
Right? On an intraday basis, on a weekly basis, on any time frame, it's ruthless. So I think this will help us keep a little bit more mental calm, I think.
I also think you have to notice that while things like Microsoft and Amazon, which are pretty heavy weights in the queues, Amazon straight down from 146 to like 128, right? That's a pretty big move in Amazon, pretty much taken out like 3 months of grinding higher, right, in 1 week, or 1.5 weeks. But the thing, I think what I realize or recognize is that all the things that were supposed to happen were kind of happening, which is Microsoft dying, Apple's dying, Netflix died, Tesla was dying, like all the heavyweights that were carrying the markets, and the queues didn't die, right? Like queues were weak, but I think it only had, what was it, like 3.5% down last week, right? Like that's something else to notice. That means that other names that we don't follow as much are stepping in and stepping up as well. So that's the thing. Like if you have Apple down and Amazon down and Google down and Microsoft down, these are 40, 50%. Meta was down 50% of the queues, and you only got a 3% move on the queues. You have to recognize that maybe there's something else is going on here as well.
I'm a bit cynical, to be honest, GP. I'm a bit cynical. I'm not, like buyers are stepping in and sellers are exhausted, and I don't buy that shit anymore. I don't. I'm just really cynical now. I think the markets are moving to programs that are set months, years in advance, maybe to fix problems like what happened after COVID, but it's just too organized. It's just too organized to say that a bunch of buyers stepped in. I don't know. I mean, I don't know.
I'm not saying that either. I'm just saying
I'm too cynical now.
What I find is that the expectation is that if the heavyweights are getting destroyed, and you're talking about like 10 to 20% moves in a week or 2 weeks on some of the heavyweight names, and the queues aren't dying with it, it's just something to recognize. It's the human behavior part of the conversation, right? So I'm still in it's a structure and flows conversation, right? That the derivatives market is driving a lot of the action here.
Yeah, I think so.
Hey, Cookie, we got just a couple more minutes. You care to share anything else? I think we touched on all the indices and mega cap, but anything on crypto, Bitcoin, or just anything else that you want to share while we have another minute or two?
Crypto's a bit trickier, isn't it? I think crypto's moved sideways for 6 months. Well, if we say crypto's Bitcoin and Ethereum, let's say, right? So the others have bled out. But I think, just trying to be logical here, I think the same problems afflict small cap crypto as small caps and biotech, meaning they're the companies or the projects which struggle to raise capital, which struggle to pay debt, which struggle to refinance, especially in this environment. And so whether it's biotech or whether it's crypto, at least the altcoins, they're going to really struggle, and they have been struggling. They've been bleeding out for a long time, and they're not as strong as, let's say, I was going to say XBI is strong, but biotech and small caps have just moved sideways. They haven't died; they just moved sideways, right, for a year, right? And I know it feels like they're dead because they just have gone nowhere, right? They haven't actually fallen off. Well, I don't know, maybe some of them have fallen off a cliff, but I think until the macro picture changes then I think they're all going to be lumped together. And, you won't see, I don't think we'll see strength in the wider crypto space until the macro outlook changes a little bit. And during that time, you'll probably see Bitcoin and Ethereum just treading water. So they'll move up and down in a range like they've done over the last 6 months, and they'll continue to do that. So Ethereum has moved between 1,500 and 1,800 since forever. Right, and Bitcoin's moved between 25 and 30K since forever, and eventually that will break. But as far as just a chart is concerned, let me just see if I can pull up a Bitcoin chart. Would this be it? Oh, this is gonna drive you guys nuts because you're not seeing this before, but let me show you a different one instead. Because I experiment with all sorts of stuff. I mean, I could spend hours talking about this, but let me find it something different. Hold on, BTC 1.0 stock twits. No, that's rubbish as well. No, hold on. Let me just see if I can get this to load up. No, just wait. Bear with me 1 second, right? Just bear with me because I didn't have one of these open. BTC 1.0, could it be that? Okay, that'll work. It's a bit busier, but anyway, it'll do. So this is a chart which I did share on Stock Twits a couple of weeks ago, hide marks and bars. So this is, if you just look at the blue channel here, so what you've seen here is price, this is going back to 2017. So you see the breakout above, price is basically meandering inside this blue channel. It breaks out again over here. It breaks down back into the blue channel after all of this euphoria. This euphoric period over here breaks down into it, and then it works its way to the bottom of that blue channel, failed breakdown, and now it's moving back inside this blue space. So big picture is, if it stays inside the blue, it's okay, right? And I've got all of these other downtrend channels, which are resistances, which is going to find along the way, which is where it has found resistance over the last 2 months. You can see this downtrend, this orange boundary here, and you can see we're coming right up against it again this week. So what's interesting now as far as Bitcoin is concerned is this period of sideways consolidation, or since what's this, March, will end within September, or sorry, will end within October. It has to end in October, and that's because this wedge closes here at 26,300 in the middle of October. So either we lose this blue uptrend channel, which will be a shame, or we break out across the orange, which has been resistant since the beginning of the summer. So that's coming to a head in the next 2 weeks. And that's why you're seeing these very tight candles now, right? So you're seeing these tighter and tighter ranges. It's also being restricted by the 9 weekly moving average above, which is basically now just acting like a guardian to the breakout. So the 9 weekly moving average, which is what we spiked to yesterday, pulled back again, just like it did the week before, just as it did several weeks prior to that. So getting above the 9 weekly moving average would see a breakout across this orange channel, which connects all-time highs and into this blue space proper, right? So 29,000, 32,000, 35,000 are all in this area over here. Clearly, the risk is that we don't break. We keep getting pushed back at 27,000. Now, 27,000 is also the 9 monthly moving average on Bitcoin. So you've got the 9 weekly at 27,000. You've got the channel edge at 27,000. You've got the 9 weekly, 9 monthly. Everything is happening at the same time over here. Everything comes together. So that will resolve in the next 1 or 2 weeks. If it stays in that space, it's great. If it's not, then, well, I don't know. It could end up being a bit nasty. But I mean, I think, even down to 24,000 is probably going to be okay. But there's been failed breakdowns below this blue channel in the past. But as always, you're looking for strength, right? So I don't want to see prices break down below a channel and then consolidate, because it's just messy. I don't want to be in there. And to be honest, I'm not holding any crypto. I haven't held any crypto since about a month and a half. So since about this area over here, I haven't held any crypto. And for me, it was, as soon as we retake the 9 monthly moving average and we close above the 9 weekly moving average in Bitcoin, I will buy Bitcoin and Ethereum again. And until that happens, I'm happy for people to get thrown around, long and shorts, leverage traders, fuck them, all of them, right? I'm not literally.
That's a bit surprising. I mean, I know that's your MO, Cookie, but I think that's the first time in the history of us knowing each other that you've held zero crypto.
Well, I've done it before. I have done it before. It's probably the second time in the last 3 years or 4 years that I've had no crypto at all. And I think it's because I'm also a lot more confident in my analysis, that I feel no FOMO, zero FOMO, and I'm confident that I have the discipline enough to be able to jump back in as soon as things start looking better. And as I said, if things start looking better, even though I might have missed 3 or 4%, I'm opening up to the possibility of making 50%. So who cares? Yeah,
it's just 3 or 4% while you're waiting, right? Yeah, exactly.
I don't give a shit. So if this is going to go sideways for the next month, then as I've done over the last 3 months, is spend that money in tech. So I've been a lot more with interactive brokers than Binance. They'll be happy to hear. So I've been basically, so most of my funds have been on, regulated exchanges and buying and selling stocks over the, since, until this resolves. And then as soon as this resolves, I'll just get back in. So I've gone, there's no bias there. There's no emotional attachment. For me, it's a trade. And as opposed to buying the technology. I don't give a fuck about blockchain. I don't. I want to see crypto do well so I can make tons of money from it, but not because I'm in love with blockchain, right? So, and I know that might surprise some people, but I just want to make a buck. And if I can make that buck with Nvidia and with Tesla, then so be it. If crypto wants to go sideways and then fall apart, then somebody else can deal with it.
You're a man after Nick's own heart.
That's the way I see it. So, I hope it does okay. I mean, I do. I don't want to see it.
Yeah. You're not praying for downfall, but there's no reason to have your hard-earned cash in there while you wait. And if you miss a couple percent, big deal.
Right. And that's why sometimes I will share something on StockTwits when things start looking like they might break higher, then I want to share that so that other people might jump in as well. But I haven't done because they haven't broken higher. So I'm okay.
All right.
I'm patient.
Cookie, thank you. Thank you for all your time, all your insight. We are everyone who listens is hopefully they absorb this. I know we're much better in the way we think about things when we have you on, and we love hearing from you once a quarter. So the next time we'll have you on will be December. We'll be awaiting Santa Claus. Hopefully, we'll be back and
4,700. Right, that was the target by December.
Yeah.
So let's see.
So let's see. Mark it down. 4,700 in December. And we'll see. But thanks everyone for listening. Cookie, thanks again for giving us some of your insight. GP, Nick, as always, thank you guys for being here. No regular TA Report podcast tonight. This is going to be our show for the week. We'll be back next Monday at 8 o'clock Eastern time. Or did we move it to 7? I forget. We're 7 or 8. We're at 8 o'clock Eastern time, Sunday nights or Monday nights. Start again next week. And with that, thanks for listening. As always, like and subscribe. We appreciate the love.